All right, my friends, I don't think a lot of you guys recognize the risks that are out there in the investment world today. I don't. I think we've been so suckered into the last 13 years, we've simply forgotten. And I just want to remind you the risks are huge, probably worse than almost anything we've ever seen. So we're going to read. Denise had written me this on an email yesterday morning. If you had a crystal ball and saw a 2008, 2009 repeat in 2022 to 23, what would you do now? All right, so we'll answer that question in just a second. This is essentially the question we asked ourselves a few weeks back. She says, I think the wise person pulls profits, pays down debt, and builds cash reserve. Well, I could not agree more, 100%. 2 weeks ago, we reduced our 401k to just a company match, 100%. For the first time ever, we reduced our cash reserves by half in favor of reducing the outstanding principal on our mortgage. Could not agree more. We're accelerating our payoff to be done in half the time originally planned. We aren't putting any new money into investments aside from the 401k reduced amount. When the market tanks, there'll be plenty of buying opportunities, and there always is in times of correction or bear market. In the meantime, we want to head into a failing economy with as little debt as possible. I just could not agree more with that. Absolutely. I'm not the biggest fans of how banks conduct themselves these days, and I'm even less of a fan of how the Fed has handled monetary policy as of late. And then, of course, Congress is fiscal. When you announce your change in stance regarding your mortgage, I applauded you. Every person must make their own decision. All right. Let's see. At worst, we owe less money and don't put money into the market for a short period of time, but we still be sitting on cash to dump back in. At best, we aren't tossing hard-earned money into a market about to tank. All right, so I hear what she's saying. I completely agree. You pay off debt. Look, man, I've still put money in dollar cost averaging. Dollar cost averaging isn't the risk that you got to worry about. The risk that you have, because remember, if you're dollar cost averaging, let's just say $1,000 a month. All right, that $1,000 a month, if it fell by 45%, that's chump change relative to the overall investments that you have. So you still dollar cost average in the market. I mean, that's what I'm doing. I'm still putting $1,000 every 2 weeks in the market, $1,000 every 2 weeks in the market, because the beauty of dollar cost averaging is as the market fluctuates, he's such a beautiful boy. He's over there, we call it making his bed. He's got his, what a knucklehead. So dollar cost averaging, you don't have that much at risk when you're adding money to your current portfolio. The new money you're putting in isn't very big relative to the bulkhead that you have there. Taking profits off the table to put into cash, taking profits off the table to pay down debt, 100% makes sense. 100%. Without question, because that is the money that's at risk. You always got to look at value at risk, VAR. All right, what is at risk? Dollar cost averaging a couple, every now and again, that's not big at risk. But if you got $500,000 in a portfolio, the entirety of that's at risk, especially a year or two out, especially if you're carrying some debt, especially if you got no cash. You're relying on the markets to do to provide you to put food on the table. Don't do that. So I want to share with you something here, man. This is the second part of this. The 70s were stagflation. All right, 70s. There's no growth in the markets. We know from 1971 to 1981, after inflation, the S&P 500 was down 16%. From 1971 to 1981, you lost money in the S&P 500 net of inflation. That is a fact. From 1971 to 1981, you got smoked in treasury bonds. That is a fact. But I want to share with you the difference between the two things where we are today, because it's much worse today. All right, so look at this. Here is the yield on 10-year treasuries going back to 1950s or something like that. What is this right here? 1962. So in 1970, this is when your old buddy Josh was born, right there. Right, well, it's July. 7.5. Right here at the end of 1970, in the middle of 1971, 7.1. So the yields on treasuries were at 7%. So you could put $100,000 in a treasury and guarantee you'll get at least $7,000 a year, each and every year. All right, now by the time 1980s come around, we're way up high. We're double that. But still, right here, the yields on 10-year treasuries were at 7%. What are the yields now? 1.3. I think it's actually I think it's 1.5 right now. So I'm telling you, man, it's going to get worse here. So if you look at the 10-year, 1.56. So you were getting 7,000 a year each and every year back then, guaranteed by the Federal Reserve. That bond matures in 1981, and instead of getting 7, you were getting 15, 13. Not too shabby. You're getting 1.5 now. That bond matures 10 years from now. What are you getting? I don't know. But you see the difference there? You're literally getting 1,500, whereas here you're getting 7,000, 7,500. That's a significant difference. Part 2 of that, S&P 500, the PE ratio in the 1970s, right? It's hard to see. You got 19 right there, 1970. That's about 13. You were paying $13 for every dollar of earnings. Now you're paying $28 for every dollar of earnings. You see the difference here? You're doubling the yield, you're doubling the dollar, the PE ratio. And the reason you're doing that is simple, is because the treasury rates are so low. But when treasury rates start rising, what happens to the S&P 500? Well, we know this, man. I mean, when treasuries rise, the price of stocks goes down. We know that. That's what happens. And look, from 1970 to 1980 is exactly what happened. As the treasuries rose, the price of stocks went down. The PEs went down. See, look, from 1970 to 1981, we're trading at 6 PE. Why? Because from 1970 to 1981, the yields went from 7 to 15. It's the same thing here. So if right here we're at 1.5 for 10-year treasury yields, and right here we're at 30 for PE. 10-year treasury yields go up, and we're talking from 1.5 to 3. That's a doubling. The same thing happened in 1970. What happens to PE ratios? Do they go down to 5? No, but in this case they went from basically 15 right there, something like that, to 5. That's they lost 66% of the price. 66% of the price at 28 right now. 28 minus 66%, that's down to 9.52 price to earnings ratio. Could that happen? Maybe. You're still getting dividends, but back then the dividend yield. So let's take a look. Hold on a second. Get 3.5 dividend in 1970. You're not getting that now, man. What are you getting the S&P 500? I don't know. It's not 3.5. It's like 1.8. So you can half that. So you can see what's happening here. Back then you were getting much higher dividends. Back then you were getting much higher 10-year treasury bonds. And back then you were paying a whole heck of a lot for each share of, for each dollar of earnings in the S&P 500. You're paying a lot less. Now you're paying a lot more for each share of dollar earnings in the S&P 500. Now you're getting half the dividend yields you were getting, and now you're getting a seventh of the interest rate you were getting back then as well. And so we don't have the recourse of high dividend yields to see us through if the markets get suddenly pretty shoddy. We don't have the recourse of high treasury bonds seeing us through if the markets go down. We don't have that, man. We don't have the recourse of low PEs if the markets fall. We don't have that either. There is no reprieve here. As if interest rates go up and the earnings falls, there is no place to say, well, I'm just going to allow my dividends to kick in. Now you could say, well, we have low inflation. Really, do we? So let's take a look here. The inflation rate is at 6% in 1970. It actually went down because we had a recession, essentially. From 1970 to 1972, the inflation rate was going down. It's not a pure recession like we're normally here today, but there wasn't any growth, essentially. It's kind of, you say, stagflation in some regard. But be it as it may, inflation was 6%. What did the cost of living come out for Social Security? What, 5.5%? So inflation is basically 5 to 6%. So inflation is exactly where it was in the 1970s. And that's because of supply chain issues by government dictate. I'm telling you, man, it's evil crap. Inflation is high. It's not changing anytime soon. I'm just telling you right now. I wish it were. Look, you got this competing entity. You got deflationary demographics, deflationary in terms of spending. People just aren't going to spend as much. They're going to pay down debt. But then you got the quick and the easy one to obviously see, which is inflationary because of supply chains, because of government dictates and government mandates and whatnot. It's nuts. And that will overtake the deflationary demographics for the short term. Short term could be 5 years. I don't know. So you got the same inflation of the 70s, much lower interest rates, much higher price of earnings, much lower dividends. You better be prepared because that's some ugly stuff, man. The risk is significant, my friends. You can only push paper from point A to point B for the venture capital firms to make money before you start to have to produce something. And we haven't been producing much for a long time now. So you can't just sit there and say, well, in the past, this has always happened. You better be prepared for the significant potential. I don't know. You don't know. No one knows. But I'm telling you, the idea that's all just peaches and cream, man, I tell you, you better be prepared. All right, over to your thoughts. We'll see you.